One of the best places to look if you're just starting out in the investing game is an S&P 500 low-cost ETF. If you're not sure of what that is, we'll be discussing a little bit behind what the S&P 500 is, what the past performance looks like over decades, and we'll also be looking at a list of these ETFs that trade on the Toronto Stock Exchange. And of course, we'll finish it off with my pick, the one that I personally invest in. But if this is your first time here, my name's Nick and welcome to Ways to Wealth. But before we get into the video, I have a huge favor, a huge ask. If you learn something new or you get some value out of the video, hit that like button for me. I would definitely appreciate that. So what is the S&P 500? I think we'll get a better context from one of the greatest investors of all time, Warren Buffett. Let's read a little bit further what he has to say. Instead of stock picking, Buffett suggested investing in a low-cost index fund. I recommend the S&P 500 index, which holds 500 of the largest companies in the US, and he suggests to hold that for a long time. So in holding this, you're getting the top companies in the US, and you're also diversifying over 500 companies by just buying one single ETF. Further on, Buffett goes to say that he is going to invest his own personal portfolio when he passes away. 90% of it is going into an S&P 500 index, and the other 10% is in treasury bills. So Buffett is even going to introduce this into his own portfolio, and it's definitely suggested for somebody who's just beginning into the investing game. They can't go and buy a plethora of stocks. You buy one ETF that will cover you over 500 different companies. Now let's take a look at the performance of the S&P 500 dating back over decades. And we can see right off the bat that over the past 30 years, the S&P 500 has compound average annual growth rate at 10.7%. Now, it's not going to be that every single year, which we can take a look at dating back to 1992. We definitely see some positive performance, but then there's going to be periods like 2000 where you're going to get negative returns. You're also going to see that consecutively. But what we're doing and what we're trying to build is a portfolio that's going to last decades, 10, 20, 30 years, especially if you're investing in the future. And what is to be said here is that if you're just beginning, or even if you have a portfolio today, you're adding in an ETF which gives you wide diversification over a number of different industries, different companies, all for one single price. With that being said, obviously we want to play that here in Canada. So we're going to take a look at all of the names that I found that trade on the Toronto Stock Exchange. And what we can see here is all the big players. If you've watched my ETF series before, your Vanguards, your iShares, your BMO, and your Horizons. There's a product that's not listed on here, which we'll cover in a bit, but let's just take a look at some of these key names. But make sure to pause the video here just to take note of some of these names if you're going to do your own due diligence, which I suggest. Now we'll look further down the list and we can see that some of these products have two different tickers, and that's because they are either hedged to the Canadian dollar or they are non-hedged. If you want to learn more about whether to invest in hedged or non-hedged ETFs, check out my video linked above. Now we'll take all these names, we'll throw them into Yahoo Finance, and we'll take a look at some of the past performance just to see how they compare. So now that I've added all of these names into the comparison chart here on Yahoo Finance, we can see that there is a relatively similar performance, especially for three names. The VFE, the Vanguard product, XUS, and ZSP are all trending around the middle. And then additionally, we have two other products. You have the Horizons product in the purple line, and that has definitely outperformed in comparison to the others. And then additionally, a new ETF that we're introducing, not included in the past, is EQL. We'll learn a little bit more about that one, but we can see it has underperformed what the middle tier ones have done. Now let's take a look at the one that has overperformed, and then additionally, we'll take a look at the one that has underperformed. So what makes this Horizons product a little bit different? Well, let's read a little bit further on the website. The Horizons total return of the S&P 500 HXS on the Toronto Stock Exchange provides exposure to the performance of the S&P, the the total return net of expenses, and the index is designed to measure the performance of a large cap market segment of the US equity market. Now, what makes this different and why this is overperforming is the fact that it doesn't make any taxable distributions. What is actually happening is they're taking the income, the yield from all of these 500 companies are the ones that pay dividends, and they're investing that back. So you're not going to get any taxable distributions on this one, and we won't see that reflected in the Yahoo Finance chart because that's not considering the dividends that the other ETFs are paying. But if you have this in a non-registered portfolio and you don't want to pay tax on that dividend income, then this may be a particularly good one for you. Additionally, we had the one that was underperforming, and that ticker was EQL.TO, and this is an Invesco product. And what makes this one different, we can see here, is that each company is represented in the index is allocated to a fixed weight of 0.20%, and at each quarter it has rebalanced. So we'll learn a little bit more about what the other ETFs are comprised of. But what concerns a lot of people with the S&P 500 is that there's a small number of companies that make up a majority of the ETF. So you have companies like your Apples, your Microsofts. These are sitting at high percentages of the ETF. So if these companies underperform, if these companies do bad, then the S&P will be hurt even more because they have such a large percentage take of that ETF. Whereas with the equal, you're getting an equal steady performance of this ETF. It's a little bit of a safer way to play the S&P 500, and I think that's reflective of what the performance looks like. Obviously the S&P has done really well over the past 10 years, but if you have a little bit of concern about some of these big tech companies that are starting to miss on their earnings per share, this could be a good way for you to add this into your portfolio with a little bit of certainty that there's not as much risk as the other ETFs in the mix. So let's take a look at what the top 10 holdings look like. We can see Biogen, Gilead, and they're all sitting around 0.2%. But we're going to take a look at VFE, which is the Vanguard product, at the portfolio exposure, just to show you what I'm talking about. So we have Apple sitting at about almost 6% of the ETF. You have Microsoft at 5.5%, Amazon at 2.2, etc. So when these companies underperform, when these stocks fall off independently, it's going to affect the S&P 500 ETF even more. But that's about how much risk you personally want to add into your portfolio. Now that we're on the Vanguard topic, VFE is definitely my preferred ETF. This is the one that I'm holding in my portfolio personally, and you can see here that it has about a 1.3% dividend yield that's paid out from all of the companies that trade. And then additionally, your MER is about 0.09%. So what Buffett says about a low cost ETF, this is definitely it. With all of the other MERs that we've covered, this is definitely the lowest one that I've seen. And if we haven't covered it yet, the ETF is just holding all of the companies that trade within the S&P 500. So this performance should be relatively the same as what the S&P does on a market basis. Now, when we talk about some of the other products that were clustered in there, we had the BMO product, which we'll take a look at right now. And this should be reflective of the same thing. So I don't think you can go wrong depending on whether you want to invest in a BMO product or whether you want to invest in a Vanguard product. The MERs are the same at 0.09%. And I think we can confirm that by looking at what the two comparison performances are. Over the past year, they're at 2.1 or 2.5%. So these products are relatively the same. So not much deviation. It just depends on personal preference. So let me know down below if you have another S&P 500 or a different way that you're basically getting exposure to a mass amount of companies. Let me know down below also if you're invested already in an S&P 500 ETF. I hope you all enjoyed the video, got some value out of it. If you're still here with me, hit that subscribe button. I hope you have a great week in the markets. Happy trading.